The revenue, EBITDA margins have come in strong this time around. Niraj Ganeriwal, the CFO of the company, joins us on the phone line. Niraj, good afternoon, and thanks so much for joining in. I was reading the company's annual report, and over there, the chairman had indicated that the company is at an inflection point. It is at a cusp of delivering very strong returns to all the stakeholders. In Q1, the company has reported a fairly strong revenue growth. Give us a sense of the kind of revenue as well as EPS growth we should expect for the company in FY19.
Good afternoon, Ria, and thanks for this. Yes, we have seen a robust growth in Q1. And, last year we had closed on year-on-year growth in terms of 10% on revenues and more than 20% on the EPS and on the profitability. Q1 has seen a 26% growth in terms of revenue, and we do expect that this sustained growth should continue, is what we believe.
A 25% revenue growth for the full year is your guidance?
No, we don't give guidance, but you've seen that in Q1, and we believe that we should be able to sustain this growth.
Okay, all right. So if you sustain this kind of a number, then we are, expected to see a revenue of around 340 crores odd for this year. Let's talk a bit about your margins. You have been hovering in that range of around 14 to around 14.5%. Now you have a currency tailwind, isn't it? Does that help margins? Do we see it increase from here?
Oh, definitely, Nigel. There has been a positive impact in terms of the currencies. And in fact, Q1 margin should have been better on a like-to-like basis because Q1 is the period when we have the annual appraisals and increments. So in spite of that, we have been able to maintain this margins and slightly improve. So Q2, with the improved currency and with the effect of increments moving out, we should definitely see a better margin.
Okay, and any indication of the kind of margins you could improve, because you are increasingly offshoring all the work that you're getting in. So what would be the target margin range that the company could realistically operate at?
Today, we are almost at a 50-50% between on-site revenues and offshore revenues. And it's a known fact that the margins on offshore is better. We are looking at improving the offshore revenues from about 50% to maybe a 55 to 60% of our share, and this could definitely help us in improving the margins by 100 basis points to 150 basis points.
Niraj, over the last few years, y'all have been doing a lot of inorganic growth, right? You'll have been going out there and acquiring a lot of companies. Is there more plans on that front? Are you looking at inorganic growth? And also, if you could give us a sense, what's your balance sheet looking like? What's the cash? What's the debt in the books?
Sure. So, Nigel, we had spoken in the past, and we do have a string of pearl strategy where we cherry pick in terms of what acquisitions we can do, and we are constantly looking at some good assets which can look at, but, it does take time. So, answering your question, yes, we would be interested in acquiring more companies depending on if they fit the strategy we have. And in terms of balance sheet, our cash is almost 30 crores on the books and a debt of 45 crores. So the net debt is very low, and we're adequately leveraged to go in for further acquisitions if required.
Any acquisition likely in FY19?
Immediately, I'm unable to comment on the same, but as I mentioned that we are looking, and if something comes by, we have a strong team who can close it quickly.
Okay, we'll leave it at that. Thank you very much for joining in. So that is Saksoft. Believe the Q1 performance is sustainable. We'll look at improving margins going ahead on the back of a higher contribution from offshore revenues, where the margins are typically higher. Get into a break then. On the other side, this is